Good afternoon and welcome to BizTech's Asian Midday Market Watch on Friday, the 24th of May. I'm Jeffrey Halley, and along with my co-host Samantha Voon, we'd like to welcome today a great friend of the show, Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, good afternoon and happy Friday.
Yep, good afternoon to you, Jeff and Samantha as well, and as well as happy Friday.
Well, before we get into it, let's take a look and see what's been happening around Asian markets today. A sea of red. The Nikkei 225 in Japan down 1.02%. Shanghai has retreated 0.22%, but in Hong Kong, it's a pretty ugly day. Hang Seng down 1.28%. Things aren't much better in Australia. The ASX 200 falling 1.04%, with South Korea's Kospi also down 1.07%. In Singapore, the STI has retreated by 0.47%, and rounding out the grouping, Kuala Lumpur's KLSE also 0.61% lower. Kelvin, it's a pretty ugly day for stock markets across Asia. Can you give us some thoughts on what's driving that price action?
Yeah, sure, Jeff. So it seems to us that today, Friday, is to be a happy Friday, de-risking day, unfortunately, for the Asia stock indices. So I think there are a couple of primary catalysts that triggered this current sell-off in the Asia stock market. First primary catalyst is due to the fact of the very weak US major stock indices in the later half of the US session. So we see a very steep sell-off in the Dow Jones, in the Nasdaq, in the Russell 2000, and as well as the S&P 500, right exactly at the start of the second half of the US session. So the primary trigger coming out from this sell-off over here is, number one, market seems to be now getting more concerned or putting in the driver's seat of macro factors rather than firm-based micro factors. And bearing in mind that, do not forget that at the start of the US session yesterday, we see a huge pop-up in the S&P 500 and the Nasdaq 100 to fresh all-time high due to a very stellar Nvidia earnings results and positive guidance. And that particular catalyst has now been in the backseat because going forward, we are now coming to the tail end of the earnings reporting season in US for Q1. And now the focus will be more on the macro side of the story. That means, i.e., we're talking about that some people might like it, some may not like it. Is due to that frustrating potential interest rate, we call it monetary policy guidance going forward, undertaken by the Fed. So if you look at yesterday's data point, we do have a very strong the PMI, pardon me, the S&P PMI flash services PMI data for US that came in much stronger than expected. So the services PMI for US came in at a very high number of 55 versus what market is expecting of 50. Pardon me. Let me do a very quick open up the calendar again just to make sure to get that right figure. Okay, 1 second. Okay, yes, here we are. So the flash US services PMI for May came in a very sharp number, a rise of 54.8 in May. So that's the preliminary data. So that actually surpassed expectation of 51.3, which is close to about a year high. So right now, the market seems to be going the HO of too good of a strong economic data will lead to a rather negative reaction in risk asset prices, which is talking about the stock market, due to the fact that it actually slows down the odds of this number of interest rate cut in US. That means overall, we still look at markets are still looking for abundance in liquidity to drive stock market expansion, rather together with earnings growth as well as per se. So what we could see over here is that due to this very strong services PMI data from US, that actually reduces the number of interest rate cut that's being priced by the Fed Funds futures market as implied by the CME Fed Watch 2. So yesterday on Wednesday, the CME Fed Watch 2, is still looking at potentially 2 interest rate cut before 2024 ends. And after yesterday's very strong services PMI data, that particular 2 interest rate cuts has been reduced to only 1 interest rate cut that will come in potentially in the September FOMC meeting. So that actually explained that driver of yesterday's sell-off in the US stock market that is spilling over to the Asia session as we are speaking at this juncture.
All right. Thanks, Kelvin. Let's turn to look at Japan for a moment. So Japan
Sure.
CPI continues to decelerate. Kelvin, do share about that, and also what does it mean for the Japanese yen, which has trapped back above 157 today?
Yes, precisely. So if we look at the CPI data, especially the core CPI data, is one of the key metrics that the Bank of Japan monitor to decide its monetary policy stances, and as well as an aim to normalize its decade plus of ultra commodity monetary policy after it raised its short-term interest rate in March. So if you look at the core inflationary trend in Japan for April, it actually continued to actually decrease to 2.4% year-on-year from 2.9% year-on-year in March. So that actually is the lowest level since October 2022. So what you are looking at it right now is that the consumer inflationary trend in Japan is actually not showing any signs of turning up if you look at solely by the core CPI data. But don't forget over here is that core CPI data, it tends to be lagging in nature. One of the particular leading one, look at from the business point of view, of the corporation point of view, is PPI, which is the Producer's Price Index. So in fact, the Producer Price Index has started to turn up in the last 3 months or so. So it started to actually slowly, gradually pushing up from a low of 0.2% that was say at the start of this year. And for the month of April, it slowly inched higher to 0.9%. And if you monitor the trend of the PPI together with the core CPI in Japan, the PPI tends to recover first, followed by the core CPI data. But if you look at the current movement of the dollar yen right now, it's not picking up any potential recovery of the core CPI data. So market seems to be pretty much fascinated, at least in the short term, due to this ongoing broad-based dollar strength that is being seen right now since the middle of this week, and as well as this ongoing US 10-year Treasury yield that has more or less, or in fact totally recovered from last Wednesday exposed CPI inflicted losses, and is now trying to kind of retest a key resistance level at that at this 4. Pardon me, do a quick look. Okay, at that 4.5% mark, all right, this level. So any raise above 4.5% mark on the US 10-year Treasury yield could potentially put some downside pressure on the Japanese yen. So that actually explain this ongoing, we call it short-term bearish momentum that is being played out in the Japanese yen against the US dollar at this juncture.
Great answer as ever, Kelvin. Thanks so much for your I'll try that again. Thanks so much for your insights today.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda in Singapore on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley.
And I'm Samantha Voon.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partners' TV, radio stations, and websites. Remember to like and subscribe. Thanks for tuning in today.